Hello friends, this is Maverick Trader here, and I'll be discussing the euro dollar pair today. And as we can see on the daily chart, the bullish break from the symmetrical triangle formation that we had on 3rd February ran out of steam at around 1.1380 levels, and since then the declining trend and the bears have taken control, and I guess a daily closing today below the symmetrical triangle trend line, which I have extended here, or you can call it as a falling trend line which has been extended. A daily closing below this line today would further add credence to the bullish view. And let's take a look at the RSI, which is also well below 50 levels and is still quite far away from the oversold region. So there is a scope for fall. So all in all, if we just go by the charts, I guess the downside stands exposed. But let's just check out what Fibonacci levels are indicating. So yes, we see prices taking support on 61.8% fib level, which is 1.0845, and prices have found bids today around 1.0845 levels and recovered. So what's driving the euro dollar pair lower? In my opinion, the fall that we have seen from 1.1380 to 1.0860, 50% of the fall has been driven by the Brexit fears, because Brexit, most of the experts have talked about the negative impact that Brexit would have on the UK economy, but it would also have an adverse impact on the Eurozone economy as well. And the slide in the GBP that we saw last week also dragged the euro dollar pair lower, and hence I say that the fall from 1.1380 was not just due to expectations of more ECB easing, but there was also some amount of Brexit fears that got priced in euro dollar pair as well. But let's say in my opinion, a fall from 1.11 to the current level is due to expectations of more ECB easing. Now, the Reuters surveyed 18 economists yesterday, and all of them see at least a 10 basis point rate cut next week. Now, a 10 basis point rate cut would be like, it wouldn't be a big deal, because the 2-year German yield is already trading at around minus 0.57%, which is well below the deposit rate of the ECB. Even if we assume that ECB cuts rates by 10 basis points, still the yield currently is way below what the new deposit rate would be. So a 10 basis point rate cut, I guess, is already priced in by the German bond markets, and that should not come as a surprise. But there is growing speculation that ECB may have to do more, or it may come out more aggressively. I just happened to go through a Goldman Sachs reports, and they are calling for a 10 basis point rate cut, as well as increase in the size of a QE program by around euro 10 billion to euro 30 billion. So the most aggressive calls in the market right now are that ECB would expand its stimulus by euro 30 billion per month. But I feel there are chances, there's a high probability that Mario Draghi would once again disappoint market expectations, and the overall stimulus that he will present next week could indeed fall short of the expectations. And here is the reason for that. Draghi must have surely seen what happened to Japanese yen following the negative rate surprise by Bank of Japan. Yen spiked, and within next 1 week the entire spike was erased. Let's just check out if that was the case with USDJPY pair. This is when Bank of Japan announced its negative rate surprise, and the Euro USDJPY pair rallied from low of 118.48 to 121.68 levels. And see what happened in the next week. This is Monday, Tuesday, Wednesday, and Thursday. The entire gains were quickly erased, and not only were the gains were erased, but the losses were extended further, which tells me, this entire portion tells me that negative rates have not been well received by the markets. And in my personal opinion is that negative rates only tells us that the marginal efficiency of interest rate cuts has reached zero, which indirectly tells us that marginal efficiency of an interest rate hike is 100%. So markets are worried that if central banks are exploring the negative rates, how are they going to manage the hikes in future? Because with looking at the USDJPY chart, it is quite clear that negative rates do not work. Negative rates did not even work in financial markets. Forget about negative rates working in buttressing the real Japanese economy, but they weren't even successful in weakening the Japanese yen. How are the central bankers then able to manage the future rate hikes? And that is the concern that is prevalent in the markets, and that is clear from the drop in the USD-JPY pair. And so I guess similar fears would haunt Draghi. He would come out with 10 basis points rate cut, but I don't see anything more than that, simply because central bankers do note moves of initiated by other central bankers and their effects on the markets. And this time it was in case of Bank of Japan, it was like it lacked the usual bang, and it quickly fizzled out, and markets actually killed the entire move in next 3 days itself. Hence I see just a 10 basis point rate cut next week. And same thing is with QE. I guess markets are just flabbergasted with all the cheap money that has flown in last several years, and markets are now more worried about how central banks would be able to manage the paths toward normalization. And hence it's not about markets cheering negative rates or more QE, because investors are worried that okay, banks are going to uncharted territory, but then how they are going to manage the comeback, because that looks increasingly difficult. And that is why, in my opinion, there is a high possibility that Mario Draghi would stay very, very cautious, and would end up being less dovish than expected. And that could actually trigger a rally in euro-dollar pair. It could rally up to, let's say, the immediate rally could be around 1.09 levels, but I would look for a bullish break above the rising trend line resistance that I see over here. Let's say by next week's rate decision, the resistance would have shifted to around 1.1025 or 1.1030 levels, and that also comes closer to the 38.2% retracement level, which stands at 1.1048. So all in all, I would, if Mario Draghi disappoints, it would be a very simple trade to just buy euros, but I would avoid being aggressive as long as I do not see a daily closing above 1.1048 levels. And if it does so, and in my opinion, if Draghi disappoints, it will close above 1.1048 and extend the rally to 1.13 levels in the coming days. But you never know what a central bank could do, and there is always possibility that Draghi would come out with a way bigger stimulus package than what markets are expecting. So it would be like a hefty expansion of the size of the QE program, or a 25 basis point deposit rate cut, and that would be like a very a simple trade. You just have to enter the shorts and it would go down to 1.05 levels, or it wouldn't even breach the levels seen in March 2015, that is the low of 1.0463, and it could head back to parity levels. So this is what I feel about euro dollar pair, and I would just say that heading into the event, the pair is likely to remain stuck around 1.0845 to around 1.0950 levels, because there's nothing really out there. There's a risk on in the markets, and that is also helping German yields go up, which in a way is protecting euro from sharp falls now. But we have the event risk. We have the non-farm payrolls report, and the payrolls report can actually push up Fed rate hike bets, and that could lead to a fall in euro dollar pair. But then it all depends, as far as euro dollar pair is concerned, it all depends on how equity markets reach the data. So if payrolls figure is surprisingly strong, sure, it would trigger a talk of Fed rate hike this year. But then equity markets are likely to respond negatively, and if they do so, the downside in the euro dollar pair would be capped. So heading into next week's ECB rate decision, I guess the pair is likely to stay in the sideways, trade in the sideways manner in the range of around 1.0940 to 1.08 levels. So that's it for today. Thank you.